All right, we're going to get started. This is Ernie Veritimus, and this is from the Trader of Futures, and this course is Volume Profile. It's a introduction to Volume Profile. Everybody that signed up for this particular class also has the opportunity to do a training or a coaching session with me, and that'll be a full-fledged coaching session. Usually lasts about 90 minutes, and you can use that however you want. It can be a continuation of this class, or if you have general questions, or on any topic matter that you have on trading, hopefully. And but this course today, this morning, will run about somewhere between 2¼ to 3¼ hours. It all depends on the amount of class participation and how quickly we get through it and all that. It'll be in approximately 3 sections. The first section, I find, is a profound section that a lot of people should, I think everybody should pay close attention to, because I'm going to talk about trading strategy and how volume profile will fit into that, and how technical analysis and fundamental analysis all fits into that. And this is from the perspective of professional traders. A lot of retailers think that they're professional traders, and they'll call themselves professional traders, but they don't really understand the full implication of being a professional, or being a professional fund manager, having the certifications, working for a prop trading firm, etc., and how they do business on one side of the brokerage, and then how everybody else does business on the other side of a brokerage. And I'll explain that in a moment. So what I mean by on these 2 different sides of the brokerage, you may have heard a stat that's been thrown around the internet where they'll say something like 90% of traders fail or lose money. And there's actually been several studies, academic studies, that have actually proven this out. Some will say it's closer to 83%. Some will say it's 91%. But 90% is probably if you go at least to the futures market, that's probably a good number. And now, when you think about that, you would think that the brokers that are selling you service or selling you access to the markets, that would be a real problem for them. A real problem. Because, you would think that they want you to be as successful as possible, and that would give them the maximum amount of return, or however they make money. But the reality is that it is not. It actually costs them more money to have a successful trader trade through a broker than it does an unsuccessful trader, and particularly an unsuccessful trader that is trading according to their prescribed and, unpublished narrative. Now, you may think that this is some kind of conspiracy or something like that. It is. It's not a theory. It is a fact. And it's one that's been well hidden from most retail traders, and it is known explicitly by professional traders. So most people, all their trading lives, they've heard the basic tenets of trading, that you need to follow the trend, although it's a pretty good one. Set stops, cut your losers short, let your winners run, and do a very prescriptive means of risk management, which usually involves setting stops. And I'm here to tell you that the professional trader typically does things exactly the opposite. Another thing that that has been pushed on a lot of people is this idea that technical analysis is actually a strategy, and brokers would prefer that you trade often, and that should be kind of obvious why. They want you to trade often because that means more commissions for them, and not hold overnight. A lot of them will say, hey, holding overnight entails all kinds of risk, because you don't know what's going to happen overnight. Well, they want you to think that, but in fact, holding overnight actually dramatically reduces risk. Now, the truth is that brokers want you to trade as big as possible, as often as possible, and not hold overnight. And the reason for that is that it costs them a lot of money in terms of their own margin that they have to maintain to protect themselves if you kind of screw up. Now, like I said, most professional traders do exactly the opposite. They tend to hold overnight. They tend to hold for longer periods of time. Now, in fact, if you were to break down the three different styles of trading, there's very short-term trading, what some people call day trading. There's even a shorter period of time where some people will call that scalping because they don't hold on to positions for more than a few minutes. And then there's a medium-term style of trading called swing trading, where you might hold for a few days or maybe a few weeks. But typically, you know, a couple of days to maybe a week. And then there's longer-term trading that is often called trend trading or position trading. And that's where you may hold for a very long period of time. Now, if you were to take all the best or most successful traders in the world and, you know, use this as kind of a barometer, and then examine the type of or style of trader that they are, the most successful traders, and by and large, you know, almost exclusively, they are position and trend traders. There are virtually no short-term traders and very, very few swing traders that are considered the most successful traders in the world. There's a very good reason for that, and that reason is that as you go to shorter and shorter and shorter and shorter time frames, not only from a systematic point of view, if I were to say create automated trading strategies and try to make hay on long, medium, and short-term strategies, the short-term strategies would have the lowest degree of probability of winning and also the lowest degree of return on capital. The long-term trades have the highest degree of or probability of winning with the highest return on capital. That's strictly from doing it in an automated sense, taking the whole human equation out of the picture. Now, that doesn't mean that you shouldn't do short-term trading or medium-term trading. What it means is that you should apportion your trades or favor the longer-term trades because they're going to give you a better chance of success over the long term. But you know, there may be opportunities where you have a clearly defined edge in the medium term, in the short term. Now, for most beginning traders, it's a lot easier for them to stick with, say, the medium term because it's more understandable and you can see things happen in real time. And so that makes more sense. For some people, it makes more sense even in the short term. And that's mostly because they have that kind of gambler mentality and they think that they can beat the system. And so I'm here to tell you that it doesn't necessarily mean that you should favor one or the other, but you'll have greater chance of success if you favor the longer term. And if you do medium term and short term, know your edge, know it explicitly. And that's a lot of what this particular course is about, in understanding your edge. Now, your edge doesn't come from technicals. And I don't necessarily consider volume profile in the same class as most technicals. And when I mean technicals, I'm talking about trading off the RSI and the MACD and stochastic and moving averages and patterns. Most of those oscillators that you put at the bottom of your platform, your trading platform, are, if you would develop some of the more standard strategies off of them, none of them give you better than a coin flip in terms of the probability of a trade being executed successfully. None of them. And I've been a quantitative trader for many years. I've developed trading systems for some of the biggest hedge funds in the world, for well-heeled investors, and for my own business, and done extensive studies on this. And none of those technicals provide any kind of quantitative or statistical advantage for you. Yet, this is primarily what is taught in virtually all trading manuals or guides or courses and so forth. So why do it? Well, you do it because this is the narrative that has been pushed down from the brokers. And all right, so this is gonna be my one last part of this. I know this because I was one of the original people who actually brought online trading to the internet. All right, I worked for the exchanges. I worked for the markets. I worked for the two biggest brokers who originally brought online trading to, that would be Fidelity and Charles Schwab. I was their, chief administrator technologist that would merge the business with the vendors to put all this technology on the web. And this was a stated policy. This is what they were trying to do. They were trying to create an environment, and also they put out services in the form of their sell-side analysts and their consultancies to train people how to trade for the very purpose of doing exactly what I'm saying. Trade as short-term as you possibly can, as big as you can, and as many trades as you possibly can, and do technical analysis and set stops. They love that, because what that means is that that's going to maximize their commissions. But it had the effect of also providing what was essentially a non-strategy, a very poor strategy, and most people would fail, and most people would succumb to emotions and other things and fail. They didn't care, because once you were gone, someone else would take your place. And amazingly, a lot of people will just keep on coming back and ask for more. Over and over and over. I know it's funny, but it's the truth.
I'm sorry. Sorry, forgive me.
No, that's okay. But
okay.
And it's the
this
truth.
This is your mea culpa, isn't it?
Yeah, it's unbelievable, but it is the absolute truth.
I believe you.
So pro traders do exactly the opposite, quite frankly. Yeah. Setting stops in the eye of most pro traders. Now, I don't mean catastrophic stops, but setting stops in the manner that most people are talking. Oh, I have a 2-to-1 risk reward. I'm risking 1 to make 2, or something like that. And then they set a stop. It's almost a guarantee that you're going to lose money. I mean, it's like saying, okay, I'm putting my stop here, and this is where I'm expecting the price to come down and hit that stop and get me out of the trade. All right, so now I'm going to give you how pros approach trading. First of all, they don't trade a particular strategy. They don't trade on technicals. They always have like a big picture narrative and fundamental analysis of whatever market or asset or commodity that they're trading. And they try to identify an edge, and that's their strategy. And then they use the technicals to help them refine or model that occurrence so that they can then get the appropriate trade. So 80% of their strategy is fundamental, and 20% of it is the technicals. Now, for most people, it's exactly the opposite. And for many people, they don't even consider fundamentals at all. They think they can come into any market and use technicals and figure it out and be able to use these this hocus pocus, and I'm going to say that, things like Fibonacci and Elliott wave and RSI and all these other, trying to find trend lines or support and resistance through these kind of arcane methods. That's not what and it's usually in the context of just trying to do it one way. They'll find a strategy that someone will say, on that is very technically oriented, that use a certain moving average, and so many bars you take, when it goes above or below, that you take the trade, and then they'll have some stop or whatever it is. And they may find some success here and there with that, depending if it's a trending market or not. If it gets to be a choppy market, all of a sudden it will fall apart. What a professional trader does is, and this is I'm going to give you in a very concise way. And this, for the next 5 minutes, I'm going to tell you what the holy grail of trading, and this is what all hedge funds and institutional traders do. First of all, they develop a systematic approach to their trading. And within that system, this is sort of a cyclical system. The whole idea of the cyclical system is that you evaluate your strategies and methodologies and everything that you're doing on a periodic basis, like a project plan. You allot so much capital, so many strategies, you execute, and you put those strategies to work. And at the end of that period, whatever it be, a month or 3 months, I happen to use 3 months, I call it a campaign, you do a retrospective on what you did. And then you decide, do I continue with what I did? Or do I take all these other strategies that are in development, what I call a curation, and do I replace them or modify them or add them? And they'll do this according to whether their strategies are working, whether the market conditions are appropriate, the context of the market. And so the strategies that they use are not all the same. And fundamentally, this is what they do. They choose multiple non-correlated strategies. What that means is strategies that take their cues from very, very different things in the market that are uncorrelated to each other, and then their returns are also uncorrelated. And when I say uncorrelated, I'm talking about in the statistical sense. There's actually a statistical feature called, or function called the correlation coefficient. And you can measure the amount of correlation there is from one return to another by putting it, as a matter of fact, Excel has a Correl function that does this, and it will create a matrix. So you can take all your strategies by, all the different instances, and then correlate them with one another. And then you get a matrix of numbers. And the correlation coefficient is a factor that is measured from 1 to -1. 1 being perfectly correlated. In other words, they're probably the same strategy working on the same thing, and they take the same trade and get out at the same time, et cetera, and so they have the same returns. And then you have perfectly uncorrelated, where they're so different that when one's going up, the other one's going down. And what they're trying to achieve is take all these different strategies and match them in such a way that they choose the ones that have as close to 0 correlation as possible. Now that sounds very heady and tough, and but I'm saying from a quantitative point of view, this is exactly what a hedge fund does. They go long and short on things. That's what hedging does. They're doing it trying to create what some may term a delta neutral position, or a low correlation between those outputs. And the reason why they do this is that, first of all, each individual strategy they can never rely on. I'm going to be done with this in a second. We'll be getting to the volume profile, but this is very important. Each individual strategy cannot, some of them may be really good and last for a long time and work in a wide variety of markets, but have a fair amount of volatility. Others may work very well in very specific market contexts, and then they have hardly any drawdowns, but when it gets out of that context, they completely fall apart. This is the nature of strategies. Some of them work, some of them don't in different markets. Some of them, now, however, if you take all of these strategies together and through your testing and everything, you find that they're generally pretty good strategies. They don't always work perfectly. And you run them all together, and you find that they're all non-correlated. What will tend to happen is when you have drawdowns in some strategies, the likelihood is that other strategies may be doing okay or good. And so that has a tendency to minimize the drawdown. And if they're all basically okay strategies, meaning that in the long run, they tend to have a positive equity, then those equities will be additive. So now what will happen is by combining all these strategies together, you get a smoothing of the overall equity curve once you add all those equity curves together, because they're non-correlated. And that degree of non-correlation is very important for this to work. And you start getting a very smooth equity curve that tends to minimize the drawdowns and then add the profits. That is the holy grail in trading. And it is the reason why my first mentor said to me, one of the very first things he said to me is that trading is the hardest way to make easy money. And that is because there's so much upfront work that you need to do to figure out how to preserve your capital and put all your strategies in a very systematic approach to actually make money over the long run. Now, there is one other aspect to this that most people avoid, and that is that they think that trading is all about getting a bigger and bigger trading account so that you can get bigger and bigger position sizes so that you can, kill the market. That's not what it's about at all. As a matter of fact, most successful traders are focused on creating multiple forms of or streams of income, maybe from different classes of strategies or things or businesses that they have in the market, maybe from other businesses that they have, maybe serving clients, and then other things. Just like the multiple streams of or the multiple strategies, non-correlated strategies, the other strategy at the high level from wealth building is creating multiple streams of income too. So it is best to take your trading and perfect the engine of that trading, and then take the profits and the output of that trading, and that should be going towards your wealth building, right? So, the property that you own, businesses that you run, income property, long-term holdings, investment grade collectibles, anything that has the ability to appreciate over a long period of time. And if you look at the most wealthy people in America, they're a good example. Most people invest in investment real estate. But that's what you need to do. You need to say, okay, I'm perfecting this trading engine. It stays relatively the same size. And then as I build my wealth, if you get to different levels of wealth, then you can start building your engine. Or multiple engines. That is the other side of the equation of the holy grail of trading. And that is that you shouldn't be focused on trying to build that trading account. You should be focused on maximizing its efficiency and then taking that money off the table and putting it into your wealth building activities. All right. So hopefully that makes sense.
Extraction.
Extraction? Is that
taking it out?
Yeah.
And putting it in real stuff.
That's right. Because what will happen with most people is that they'll start building their trading account and they'll start creating a bigger and bigger position size, and then inevitably what will happen is that they'll run into that period where their strategy no longer works. As a matter of fact, their position size is so big and their head is so big that they end up eating themselves and basically wiping out their account. It happens all the time, 90% of the time.
They have nothing in return.
That's right.
Yeah.
So taking profits off the table is absolutely essential. All right. So what I'm going to do, am I sharing the screen right now? Or is it just my face?
I just see your face.
All right. So what I need to do is find Zoom. And I'm going to share the screen and the presentation, and we'll start getting into the presentation. Like I said, the first part will be a very short review of what I just said, and you'll get this presentation too, so to remind you. So here's the presentation. And it, in the coaching session, if you want to go over this type of stuff, I'd be happy. If you want to go over more of the volume profile stuff, I'd be happy to do that as well. So principles of pro traders, just like I said, day trading hardly ever works. Diverse non-correlated strategies do. Holding overnight and hedging increases your chance of return. So in other words, going long and short on a lot of different strategies and positions is better than actually setting stops. Now you can create very, catastrophic stops, and you can decide, what is the, the place where you can no longer tolerate that risk. But ultimately, what you want to do is you want to trade really, really small. And that's what I do. I trade very small, and I figure out what a full position size is. And then I break that up into 3 or 4 chunks, and I always enter in small tranches of that position. And sometimes I don't put a full position in because I'm not confident that the strategy is working. And so I don't want to risk as much. Monthly income is a myth. I didn't cover this, but To think that you're going to make a monthly income off of, say, a $100,000 trading account is ludicrous. No pro trader worth his salt will ever tell you this. However, everybody on the internet will tell you that you can create monthly income from trading. Again, broker narrative. What happens with most pro traders is they realize that maybe 2 to 4 months out of the year are their winning months. That's where they make virtually all of their winnings. The rest of the time, they're concentrating on one thing, and that's preserving their capital. All right? Now, that doesn't mean that there won't be opportunities. There are always opportunities, but they're holding it close to the vest, and they're trying to preserve their capital at the foremost, and then take advantage of the situations where they know that they have a good risk reward. So making an income is ludicrous. It would be a lot easier to make that income by having multiple streams of income to assure, because not every stream will always perform. The one that performs best on a regular basis is like income property, but even that can have its ups and downs, or a business. Trading, and as I said, trading is the hardest way to make simple money with a systematic approach. And that system is the hard part, because it takes, there's a fair amount of complexity. Systems trump getting your feelings in check. This whole idea that you can get your feelings in check is total bull. No matter how, Buddhist that you can make yourself, there are going to be times where you're going to be elated and other times where you're going to feel like crap. And there's nothing you can do about it. The only thing you can do about it is have supreme confidence in your system, because you've proven it. And it's the confidence that actually overcomes emotions, right? Not any kind of, new age crap. That doesn't work. Risk management is also bull. In other words, setting stops on all your trades. Guaranteed way to make you lose. You'll often find that you'll set stops and then you realize that, man, it hit that stop, but then it came back again. And it happens a lot. Well, that should be telling you something. Either your stops are too tight, or you shouldn't just be setting stops at all. Maybe you should have a different strategy for how you're going to control that risk. The way you control that risk is by all your positions being relatively small and having non-correlated strategies running at the same time, going long and short. That gives you this sort of delta neutral position, so that even in the event of a market crash, some of them will go up, some of them will go down. That is how institutions, professional traders, and hedge funds manage their risk. So why isn't that good for a retail trader? It's not good for a retail trader because they're looking for the quick buck. They're looking for that one holy grail strategy that will make them millions of dollars. So unfortunately, there is no guarantee that you're going to get your Lambos and hoes and villas because you trade. All right? So I'm not here to teach you how you're going to get the Lambos and hoes, all right? That's not what this is about. And again, here's that winning strategy. Develop a system with a cyclical process where you reevaluate everything you do, a continuous improvement process, a hedge portfolio with multiple strategies, using mostly fundamentals to figure out what your edge is. That's extremely important, and then apply the technicals to fit that hypothesis. Look to make returns that are multiples of risk, and this is where volume profile is going to help. I'm going to show you how you can position yourself and position your trades where you have the least amount of probability of a trade going against you, and the targets will be very big. So the risk to reward, or the perceived risk to reward, will be very, or the reward to risk will be very large. Set realistic expectations. Perfect the simple. And I said this in the very beginning to you, Chad. I think I said that the first thing you should be concentrating on is how to not lose money.
Yeah.
All right?
Yeah.
Perfect the system first. And then when you can stop losing money and you can consistently not lose money or make just a little bit of money, then you can build from there.
Yeah.
Risk management, limit your size. That's the number one way to manage your risk. and diversify your holdings and strategies. Stops should be used for catastrophic insurance only. So if you had one strategy that just went way off and was just a catastrophic loss, for some people that might mean losing 20, 30, 50% of their account. To me, that's losing 2 or 3% of my account. Right? Fundamental difference. To most of those other people, 2 or 3%, that's just a normal loss. To me, that's catastrophic. Right? That's because I trade small and I'm looking to make incremental gains. Every once in a while, I make a huge gain, and that's great. But I won't tolerate any big gain or any big loss. And then finally, what I said before, the growth mantra is capital preservation first, profit second. All right, now we're going to get into volume profile. Hopefully, what I want to do is orientate everybody to the way pros think, not the way retailers think. All right. So one thing I can say about volume profile, a historical note, is that up until the 80s, the late 80s, nobody had real-time information from the market where they could then fashion it into charts. Nobody, even pros. Maybe in the early 80s, late 70s, some of them started to develop these things. But first of all, there were no networks. There was no way to get it. Then came along things like CompuServe and other online networks. The networks didn't exist. And then we finally started to get into DARPA and other things that led to the internet. And then they started to get feeds into the institutions and the brokerages. And then they started to do some real-time stuff. But essentially, they've been using a form of order flow from the 1850s up until the 1980s. In other words, order flow meant that they would get the orders in, from a customer, and it would show how much someone wanted to buy of what thing, right? And over time, in the turn of the century, they started to develop a method where they could automate this order flow and then transmit it out to a lot of people in the form of a ticker tape. Now, a lot of you that are old enough may remember some of the ticker tape parades of the 60s, 70s, and 80s. And those were the actual order flows that they would use, the orders from the market. And that just basically showed, what stock was traded at what price and what volume. Well, for all this time, all these successful traders, they weren't using technical analysis or streaming charts or anything like that. They were going strictly by order flow. And so they understood, the accumulation of orders at a particular price meant, hey, the market was developing an affinity around that price. And so there they could determine supply and demand, or where the demand was and where the demand wasn't. It was where those orders started piling up and that was where the demand was, and the lack of demand was where it wasn't piling up.
When you say market, are you referring to just individuals for some reason or another felt compelled to buy, and institutions compelled to buy a certain stock at that time, and that would draw up the volume?
Yeah.
That simple?
Yes.
Okay.
Yeah. Why it happens, it could be this sort of information, flows through the market and through the airwaves, and people pick up on that information, they react on it, and they react on it in certain ways. And it's like any other distribution, and I'll talk about this in a little bit about normal distributions, but people get information and then they act on it. Most people act in one way, and then that kind of varies over time. And then you have the outliers of people that a few people act in a very different way.
Yeah. And
that all kind of distributes, over time. Well, in the 80s, they started realizing this. They created something called market profile. And they were able to get some, at least relatively real-time charts. Every 30 minutes, they would get candlesticks. And so what they would do is they would then take a day's worth of candlesticks every 30 minutes, and then they would squeeze them over to the left and then pile them on top of each other. And that's what you're seeing in this chart here with all these letters and the multicolored thing here. The A boxes would represent the first 30 minutes of the market. The B box would represent the next 30 minutes, and so on and so on. And so from this, they started to develop a profile of what was happening in the market and where what levels that the market was concentrating on. And they could also see, you know, how it was developing. And so you can see here that there were prices, like in this top one, where there was an affinity for that particular price. And then something happened during that day and on the Q bar, and it moved down to another price. Some big time frame players, some bigger people, whales, people that have a lot of money, decided that value wasn't there anymore, it was somewhere else. So they pushed the market down very quickly in one candle.
That's the Q?
Yeah, that's the Q. You can see the Q, it's like a light blue.
Okay, yeah.
And those are only people with big amounts of money have that ability to do that.
Yeah.
And then after they've moved it down to that area, then the shorter term time frame players, the medium term and the short term, start auctioning off on it, and then start developing an area where they found value. The market finds value wherever the big guys push it somewhere, then the market try to resolve that where that value actually is. That's what happens. That's how the market works. And so it would develop these profiles, and from those profiles they could do an analysis seeing where traders and market makers and others are deciding where value is in the market. And they could do, through that analysis, they could figure out where price was going to tend to gravitate and where it was going to tend to avoid. All right. And it's kind of like a mass psychosis that develops. I mean, that's how markets build themselves. Now, over time, when we started getting more real-time information, we were able to then substitute that with volume at price, and that's what a volume profile is. It is the number of orders that occurred at specific prices. And if you notice, where the market profile was almost exclusively price, now we're talking about volume at price. In other words, this is sort of like the ticks that happen in the market on the left-hand side. On the right-hand side is the actual volume at price. And that's actually what people used to do long ago. If you ever read stories about Jesse Livermore, some of the greatest traders in the world, they took orders and they stacked them up, and they figured out where the price was for those things where there was value and where there wasn't value. And so that's essentially what a volume profile is. And if you look, it's very close in nature to the stack up of the market profile. But this is actually much more accurate, because this is showing where the actual volume occurred and where the demand occurred in the market. All right. Now, there's multicolors here. You don't have to pay attention to that. There are different ways of expressing the volume profile. The multicolors indicate long and short positions within that price. So green might be long and red might be short. The darker area we'll talk about, that is the what's called the value node, or the one standard deviation. When I talked about normal distribution, if you've taken statistics, you'll see in a bit what all that means. So now, one thing you should also consider too is that the market and all the market data that's coming in, there are three essential pieces of information that are coming in. Well, one of those pieces of information is a time stamp. It's time regulated. The other two pieces of information are price and volume. That's it. Those are the only pieces of information that are coming in from the exchanges. Nothing else. Now, virtually every chart will show you price and volume at the bottom. But for some reason, virtually none of the charts that you can buy or that you can't buy, or they're all free, that come standard out of the box on charting systems, will show you volume profile or volume at specific prices. Even though that this is the method that they've been using since time immemorial to actually determine where value is, they don't show you that. And again, this is part of the broker narrative. They will not show you that, even though that this is what the professionals have been using from the very beginning. And the only place you can get these types of systems is if you pay for them. And TradingView is actually doing a really great service. They have a fantastic tool, but you got to pay for it. You don't get it out of the free version. Yeah. There are very expensive trading platforms like market delta, which also shows you market profile, but shows you volume profile as well, that you pay a hefty sum, a monthly sum, that is generally used by professionals to show you this type of data as well as very sophisticated analytical tools that don't exist in TradingView. But for the most part, you can use volume profile to see these to see this stuff. I mean, it's basically the same information, but given to you in a much more concise form than they had prior to 1980. And apparently, there were a lot of people that were very good at trading because they had this information. It's not like everybody was trading in the dark. Hopefully, this is some of this is sinking in, and you're getting the picture.
It's very logical when you the way you're teaching. So I'm grasping some of the concepts right now.
Excellent. So this is kind of a repeat of what I just said, that price with respect to time, volume with respect to time, and then there's this derived set. And what I don't understand, what they should have had all along, is they should have volume with respect to time, because that's actually more important than any of these others. In fact, most prop trading firms, proprietary trading firms, don't even use the price chart. They only use the volume profile and the order flow, the actual orders that are coming into the market. And I'm going to tell you right here that you could actually trade this way. You don't even need the price chart, although there are some advantages to using it. You don't even need the price chart to do effective trading. You can use strictly the volume profile because it has all the information. It has the volume at the price. But, it'd be dumb to do that if you have an advantage of having the price and you can see certain patterns that do have a statistical advantage. And I'm going to show you that as well. So the next thing we're going to look at.
Will we be able to get what we're going over and watch this again? Because I'd like to.
Oh, yeah. You're going to get a replay of this.
Take more detailed notes for myself. Really.
You get a replay of this, and you'll also get a PDF of the of the presentation.
Okay.
So one thing you should know about markets, and this is something that I mentioned a little earlier, I said that the big market makers, they tend to move the market in the direction that they want, usually from some news event or some other thing that they decided that was important in the market, and they move it very quickly. And then the rest of the the bees, they buzz around it, and then they auction it back and forth. And so if you look at markets, you'll see that they tend to trend and then consolidate. And that kind of very clearly illustrates this exact process. The trending part is the big market makers pushing it. And then the consolidation part are the shorter term time frame traders auctioning it off and establishing where the value is. So markets trend about 30% of the time, and then they consolidate about 70% of the time. And it's here's a TradingView chart of Bitcoin. It spans over a few months. It's a daily chart, so each bar is a day. And you can see the volume profile on the right. You'll also see tiny little profiles, or what we call balances, that are mini versions of the volume profile, but they only extend over that specific range of price bars. And so you see each one looks like a little volume profile with a dark center and lighter outer edges, which I'll explain in a bit. So those are two types of profiles that you can create in volume profile or in TradingView. And while we're here, I'm going to go over that right now just to show that in a little bit more detail. I think I have to change the sharing. What are you seeing right now?
I'm just seeing the chart with Bitcoin, and then imposed behind that the volume.
All right, this is what I want to show. I need to yeah, I want to show this. All right, so you see a black chart with,
Yeah.
all right. So on the right-hand side, you can see we have the volume profile.
I
And
can't quite see the volume profile because I see me and you on the right side. I can't quite make out the blue bars. I can see some of them, but I can't see them all.
Oh, all right.
But I can,
How about now?
if you shrink it a little bit more, I'll be able to see it. Looks like they just went green.
I'm going to try a different way of sharing the screen.
Okay.
Can you hear me?
Yeah, I can hear you.
How do you insert the volume profile? I can't find it on my chart.
All right, I'll show you. That's exactly what I'm going to show right now.
I can now make out the green, and then some of the blues are coming out. The maximum volume profile, I can see those lines as they correlate with. Okay, that's excellent. Yeah. Okay.
Does that work good?
Yeah, it's not all the way inward, but it's good enough. I can. So.
I'll do a little bit more.
Okay, fine. Good.
All right. And okay, so what we're seeing here is just a regular chart. On the right-hand side is the volume profile. I'm going to get rid of everything here by removing all the indicators, all the drawing tools.
Okay.
And let's get rid of the volume profile as well. Now, the way you add a volume profile, first of all, this requires a subscription to TradingView. And it doesn't require the biggest, just the minimal subscription. I think it ends up being about $14 a month.
Oh, okay.
And you can get a trial version for I think 2 weeks. But when you go to indicators on the left-hand side, when you get the subscription, it will show up volume profile right there. Now there are 3 different versions of it. There's the visible range, which I just took away, so I'm going to add that back. All right. There's also this thing called session volume. And if we choose that and then close, well, it's not going to show it on here because these are daily bars. However, if I go to because it's going to show the session, it's going to show you a volume profile for each individual session. So if I went to, say, a 30-minute chart, oh, now I have to resize everything. You'll see that it's going to look a lot like it'll go for each day. It'll show you a profile for each day, for each session. In Bitcoin, that's a 24-hour session. If we were to go to something like, I don't know, the S&P or the SPY, you can see that it then creates a profile for each session. And that would be each market session from 9:30 to 4 o'clock in the afternoon. But Bitcoin is obviously a 24-hour market.
So Ernie, so you said you inserted volume profile, session volume?
All right, so watch what I did again. I'll do it again. I'm going to remove everything. It doesn't remove those. Remove all there. All right, everything's removed. I go up to indicators, and then I get this dialog. And then you'll see on the left-hand side, it will say volume profile if you have the subscription.
Yeah, I do.
All right. And then it will show you 3 different types of profile to show. The visible range brings that out. You see that pop up?
I see.
All right. And that shows you the volume profile for all the visible candles that are in the chart. Does that make sense?
Nothing pops up on my screen. I don't know why. Nothing pops up on the side of the screen like yours.
Do you get up in the upper right hand corner? It'll say VPVR, number of rows, etc.
No, I don't have anything like that.
Oh, that's interesting.
I get visible range.
But it doesn't show up. So after you select it and close the thing up.
Oh, now I got something.
All right.
On the side.
So you'll notice that every indicator that you add to the TradingView chart will show up usually in the upper left-hand corner. And so it'll VPVR, that's the volume profile. And there are two ways you can get to the, to change the input, so change the configuration. One is this little format button. You can click that, and that will allow you to then change the configuration of it. Another way is to go to the chart itself and just I think you can just double click on it. Or, let's see, can you double click on it? Oh, yeah, there it goes. I just double clicked on it and it brought it up.
Okay.
All right. And, the way I set it up, I usually set it up so that the volume is total. If I set it up for up and down, it's going to show me both the volume, both the long and the short volumes on each price area. I find that kind of confusing, and it's not it's unnecessary information. So for volume, I set it to total. It's just easier. All right, and I'll explain the different colors in a bit. The value area is set at 70. It's actually a percentage, 70%. So in other words, this blue area is the value area, and that is showing 70% of the total profile. And there's a reason for that. Actually, if we were strictly to the math of this, it would be 68%. Because 68% is actually one standard deviation, because that's what it's based on.
So you use 68?
I'm sorry. People just round it off to 70, and that's why it's up there at 70. So most people use 70.
Okay.
But I was just trying to make a kind of a nerdy point, that if you have a question?
Is that alluding to the 70-30 statistic that we just talked about earlier, where 30%? I forgot what you were talking.
No, that's just a statistic, but
okay.
it's an astute observation, because virtually everything that happens in trading is all about one standard deviation, or about 2/3. 2/3 is considered usually a majority, right? I mean, we have it in law. We also have it in our heads too, as just in the human condition. We can visually see 2/3 as being a clear majority. And it's that way in trading too, and it happens to be that way in statistics as well. It happens that 68% happens to be one standard deviation, and they consider that the majority of a set of distribution of data. And it should be that way in just about any strategy that you create. You're yearning to get at least a 68% probability of what you're doing. And it is a round figure that I like to use. I don't like to get, especially in discretionary trading, you don't want to get and try to marginalize everything and say, well, I have a 52% probability of profit, but I have a 100-to-1 return on capital. Those type of delineations are really hard. I like to just say, look, I'm one standard deviation. I've got a better shot than average of making a profit. That's the way I like to look at it. But that number, that 2/3, comes up a lot, and I would focus on that as a trader. So anyways, you can go to style, and you can add the POC, which is that red line that's showing the highest point in the volume profile. Turn it on and turn it off. There's also a developing POC and a developing VA, and I'll explain those in a bit, but I don't particularly use them because I think they just add a lot of complexity to the chart. And then you can change all the colors and everything and so on. You can choose not to show the volume profile for whatever reason. I'm not sure why you'd want to do that. Or maybe you want to show that and just show the developing VA volume area, but I don't find that particularly useful. This is my most useful view of volume profile. And this is showing you the volume at specific prices of the visible region of the chart. So this means if I change the visible region of the chart, the profile is going to change. It'll recalculate to show the visible region. You see how when I drag more data in, and then recalculates? That's a useful tool, by the way.
Another question is those volume profile bars, cover up some of the candle charts.
Well, I can move my chart around.
How do you?
I just click and drag on the chart.
I see.
So you can do all kinds of things here. You can also show, I think, how much of the volume profile it takes up of the chart. Right now, it's taking up 30% of it under the style. I could choose, say, 25% or 20%. Then it will only use 20% of the chart. I could be extreme and say I only want to use 10%.
So what exactly is the volume profile chart showing? I mean,
it's showing the amount of volume at that specific price level.
The volume at that specific price level?
Yes.
Okay.
Now, it's not important that you know exactly what that volume is. We're getting a little feedback, Howard, so if you could mute when you're not talking. For some reason, I'm getting feedback there.
Okay.
It's not really that important what the specific volume is. It's more important that you recognize the shapes, because that's what is going to guide virtually all your trading with volume profile. I find 30% or 40% are good numbers. I don't really mind the overlap, quite frankly. If it gets in the way, that's fine. I'll just move the chart over. I think 40% might be a bit much, but 30% seems to be a reasonable amount, right? But you want it big enough so that you can see these features, this what I call the texture or structure of the market. Because what you're seeing here, these bumps, you're seeing areas where the market has found value, and then the wells or the lack of bumps, you're seeing the areas where the market tends to reject price and doesn't want to spend a whole lot of time there. You'll see some of them are very, very shallow, like here, where there's hardly any time spent in that market at that point. Now that's extremely significant in your analysis of the market and where price is moving to. Price, and I'm going to say this is like a seminal point in this course, in these two statements. Price gravitates towards the nodes, these bumps, and in general gets rejected from these low volume wells. That's really important, because now that little bit of knowledge tells you in general how price is likely to behave as it traverses up and down across this structure. And this is actually a structure. And the reason why it's a structure, it's not only telling you what's happening in the present, but it's also telling you what happened in the past. A lot of this volume that happened in the past represents positions that are still being held by people in the present. That's a very, very important point. And the reason why price behaves the way it does as it goes across these structures is exactly for that reason, because there are people still holding positions with the same relative amount of magnitude that you see in the bump to this day. All right? Not everybody. Some people are out of the market, but there are still people holding it, and they will act in a specific way when price comes towards that price. They're going to want to act on that. Either they want to get out of the trade or add to the trade or take profit or whatever it happens to be. They may want to defend that position, depending on what size of a trader you are. That's why the volume profile is so significant, because it will show you, and this is something that, like I said, the early on traders, they all knew. It shows you where the demand is, and it shows you where the demand isn't. And price tends to move. Either it runs very quickly, either it gets rejected by that low volume area, or it runs through it very quickly, trying to search out another area of value. And it usually will find another existing area of value to gravitate towards. Sometimes there isn't, and maybe you're going straight up and there is no historical reference, but it will find an area of value and it will start consolidating there. And then it will establish that as the area of value, and it will those will be people that will actually hold positions there. So that is a fundamental thing that gives you a huge advantage in your trading. And if you start looking at the way the market behaves, you'll notice that when it's trending, it tends to find an area of value. You also find these low areas are areas where price tends to skip right through, like right there and here, or has a tendency to use it as an area of support or resistance. So when people tell you that trend lines are showing you support and resistance, that's not what's showing you support and resistance. Or moving averages, that's not what's showing you support and resistance. The market knows nothing about trend lines and moving averages. The only thing the market knows about is where they have positions and where they don't have positions, where they find value and where they don't find value. That is what is actually causing the areas of support and resistance, these low volume wells and these high value nodes.
Would the low volume nodes also correlate just basically with confidence? If there's no confidence in buying something at a certain price, it won't be bought.
That's right. Well, whatever the psychology is.
Huh?
The thing is, we don't know what the psychology is. We don't know why.
Yeah,
there may be very specific
true.
reasons why. Yeah. Why is it that the lowest volume is at 61.71? I have no friggin' idea.
Right.
But the market seems to believe that that has cooties or something.
Yeah.
Who cares why? There may be a very specific reason why, but it doesn't matter.
Right.
They behave a certain way when they come near that area. They try to zip through it or bounce off of it.
So why are some of the bars blue and some are green? What's the difference?
The blue area represents the 70% area, and we'll cover that. And then the green area represents the area that's not the 70%. So in other words, the 70%, this is the 70% of all the volume that has occurred in this chart, occurs in that blue area. All right, and I'll show you why they do this in just a second. We need to go back to the presentation. And I'm assuming that's what we did. You can see the presentation now? Or no?
I see it on the left side of my screen. Well, I can't see it now, but I
Yeah,
can see it.
I'm gonna just redo the share screen so that we're focused on the presentation alone. All right. So I mentioned this a little bit earlier. I said that there are different types of traders or actors in the market. There are these long-term traders. They tend to be the big whales. They tend to move the price in a trending way. And then there are the medium and short-term actors. That's basically the swing traders and then the day traders. They tend to then auction and consolidate the price. And while it's not important to what we're talking about, I think it is important in sort of identifying who these people are. And you'll see as you go further and further down this journey of trading how that may provide some more information for you. I want to say that the indicators in general, like the RSI, MACD, stochastic, they're all lagging indicators. They are usually taking an average or some calculation of a number of bars prior to, and then trying to give you an idea of where they think price is going, and using some kind of mathematical equation, trying to give you an idea of where that might be, giving you clues. For the most part, lagging indicators aren't giving you what is happening in the real time, but volume profile is giving you exactly where the price is and how the market is behaving in the present moment. And for that reason alone, because it's showing you the actual truth of where price is and where the volume is and where the demand is, should be reason enough to say that, hey, volume profile is really the superior indicator. Now, that's not to discount a lot of these things. I'm sure they can give you different views of the market. So I'm not going to say that you completely discount any of these things. But I am saying that I can completely eliminate all of these from my charts and not miss any of them. From a long-term quantitative analysis of these things, I've proven that out. So that's completely up to you if you want to use these things and develop strategies around them. It might work for you. I'm saying for my own personal use, I don't use them anymore. And I was a diehard in them for 30 years, even developing sophisticated strategies around them. So I've talked about all of this stuff before, and I'm going to get into the meat about what we were talking about before, the dark and the light areas. What you're looking at here is what's called a normal distribution of a data set. And this is a statistical chart. It's what some people refer to as the bell curve. And it's showing you an occurrence of something that happened. And this is like a perfect normal distribution. This is how, if in a perfect world, if we had a set of data, how it would be distributed. One example of that might be IQs, right? So we know that IQs can range from low to high. They can go from like 60 to 200. But we know that the outer bounds of those IQs, those are extremes. Those represent very, very few people. By definition, in an IQ, most people are set on 100 as an IQ. Over the world, maybe not in America. It's actually a little higher than that. It's like a little under 110. But over the world, IQs, the vast majority of people are right at 100. Now, if we were to look at IQs in terms of this, we would find that in this dark blue area, IQs that fit within that dark blue area are approximately from 85 to 115. And that represents about 68% of the population that fit within that area. People with IQs of, say, 135 or 150 or above, they're out in the 2 standard deviation or even 3 standard deviation. They're way out here. People with very, very low IQs, they're way down here on the left-hand side. But this is just showing that distribution. Well, and as I'm saying here, normal distribution used to quantify the amount of variation or dispersion of a set of values. Now, volume profile is exactly that as well. Volume profile is the variation or dispersion of volume of a set of prices. So if you take the normal distribution and then flip it on its side, that is essentially what you're seeing, like right here, in volume profile. You're seeing the distribution of prices or the distribution of volume over a set of prices. And we can see right here at this point, that is the highest point right there. But you can see it's not perfect. It's not a perfect distribution because in the real world, there is nothing that is a perfect distribution. There are things that come very close, but they're not perfect. And to illustrate that point,
could you move that over a little bit?
Oh, yeah, I'm sorry about that.
I can't see the distribution on the right with the volumes. If it's possible.
It's actually not possible.
But I can see it's part of a PDF file, so when I print this up, I'll look at it again. So that's okay.
Yeah. I don't know. Is there a way to minimize those boxes?
The boxes that we're seeing each other on?
Yeah. I think you can also put them to the top. I mean, or
Okay, let me see. There we are. I see just you now. I see
Okay.
it now. Okay. Yeah. I can see the whole thing on the right.
All right, so you can see it looks just like the normal distribution set on its side.
Yeah.
And the dark area represents the one standard deviation, or about 68%. Actually, we rounded it off to 70%. All right. Now you're getting, you know, all the geekiness, you know, where all the geekiness comes from. And that is the one standard deviation. So 70% of all the prices, all the volume happened within these set of prices over this chart. Now you can use that from a statistical point of view, saying that, well, you know, we're here, you know, there's a 70% probability I'm going to stay somewhere within that region, price movement. That would be one way of looking at it. Another way might be that, well, if I'm going to move up, I'm probably going to try to move towards this other high value node here, because that seems to be another area where the market has found an affinity or some demand. All right, hopefully this is clear. Now, here's a chart.
Related to Q? Because Q, in the earlier chart, looked like Q was going in a similar pattern. Yeah, I don't know. No big deal. I was just curious.
So here's the idea that, you know, not all distributions are perfect. The red line might represent what is considered a normal distribution, but some distributions are heavily weighted towards the middle, some are flattened out, some are skewed. So there is no perfect distribution. There is a normal bell curve distribution, but if you were to take the distribution of a set of data on just about anything like IQs, they tend to follow this distribution somehow. So let's talk about the anatomy of a volume profile, because there's a lexicon that we use. There's a balance. Now remember when I went way back here, and I showed you all these tiny little distributions, and I'll show you how I create those. But each one is a separate little distribution. There's a term that we use that's taken down from the market profile days. They call that a balance. And in fact, if you looked at the big one on the right-hand side, we would also call that a balance, but typically they don't call that the balance. They call these tiny little ones that we draw in here as a balance. A balance is also often referred to as a distribution that kind of looks like a normal distribution. Some of these I wouldn't consider balances, like they're unbalanced, like this one right in the middle. It has a long tail with a big bulbous top. So that's just another term of art that's been used for many years. All right. The value node, that's the big dark area. That represents about 70% of the total volume over the balance where the market finds value. The point of control, or the POC, that's the highest volume at that price in the balance. So if we were to look at this one, this highest volume is right here. You can see it clearly, and there's a little red line. If I were to go back to Google Chrome to the chart, I guess now I can move it over now that you've moved those things. We can see that the POC automatically gets drawn on the chart. You can see it by a red line here. That's the point of control, or the highest volume over this entire chart. Now, one thing I didn't show you is how you create those smaller fixed range balances. You do that by choosing indicators, volume profile, and then clicking fixed range, and then close it, and then click and drag across the area that you want to create one of those little balances, like right here. And that will create a little balance for you, a little profile. but it will only be for that range that you dragged across. Now that might be useful to you if you're doing, some other trading and seeing various things happen, and you want to get a little bit more precise about where the value is in the near term. Because I'm going to give you this set of rules that the closer the profile is to you, the more significance it will have. The bigger the value node is, the more significance it will have. So that follows that the closer and bigger a node is, the more significance it will have. The further and smaller it is, the lesser significance it will have, because it's more in the past. All right? That won't necessarily, now if there weren't any other features around and that's all you had to go by, then that's all you have to go by. But just take it as a general rule that so for instance, let's say we take the present day and I create another fixed range here, and I want to look at, from here to here. Well, I can see by this, and it has its own POC right there. That probably has more significance than, say, other features that are out here or over here. Although they're all additive, and they all contribute to the big volume profile. So this is just sort of a nuance and something that a tool that you may use. Some people never use this. I don't use it that much, to tell you the truth. But it's there. And so now I've shown you all the different types of profiles that you can create on TradingView. We showed the session view, which only shows the specific session, trading session. The extended view, which allows you to draw a profile and then look in greater detail a particular consolidation or any portion of the chart. You can maybe extend it out to here so you could see what this profile looked from it, moving and trending up and then consolidating here. Some people analyze those things and they are significant to them. So it gives you a lot of flexibility is the point. All right. It's interesting. We had a pretty big drop in Bitcoin here today.
How do I remove one of those fixed range profile we just created?
You can click on it, and then I just hit delete. I think you can also right-click on it and remove it. Did you see me do that? I right-clicked, and then a contextual menu came up, and it had to remove. The other way to do it is you just select it and then hit delete. So I can put one here. And you can tell it's selected because it has these circles. And then
how do you select them?
Just click on it. Like I'm going to click away from it and see no circles on it. And then I click on it, and it's showing it's selected by these little circles in the upper left and lower right corner.
I select them, but I don't see any circles popping up. Sorry.
You have to click on the profile. If you click on the area, it won't do it. You have to actually click on the...
okay. Okay. And then
hit delete key, and it goes away.
Hit delete key?
Yeah.
Okay. Okay. Gotcha.
All right. So we'll go back to the anatomy.
So Ernie, basically you were saying that you only use the large one on the right side?
For the most part. Every once in a while, I'll use one of those little extended ranges just to get a better feel, especially if I'm in a smaller time frame and I want to get a better look at, where the point of control is.
Okay.
All right. But it's kind of a feel thing. I generally don't use them, but every once in a while I do. All right. So we saw the balance is basically another name for the whole profile. The value node, that's the dark area of the profile. The point of control, that's the highest volume volume at price on the profile, and it's automatically indicated by the volume profile tool. And then we have the low volume node, or the low volume well. That's the absence of a profile. All right, and so we can also see here showing that's the balance. It's just a repeat of everything I said. All right. So now let's now we've talked about like the anatomy of everything and what a volume profile is, what it looks like, what it represents. Now I'm going to start getting into techniques on how to use it and what I do. And remember, I said that when you think of a volume profile and those nodes and the volume wells, think of it as the structure of the market. And that's exactly what it is, because it's showing you where demand is and where demand isn't. And you can also think about it like kind of let's say that you're driving along a plain, like a big flat open area. You're in the desert, and then there's mountains in the distance. You can think of the plain as being like the volume well, because you can zip across that very quickly, no resistance at all. But then when you get to the mountains or the hilly region, you start slowing down and start gravitating towards those mountains and spending a long time on those. And that's kind of like what a volume profile is. It is actually mapping out that kind of terrain, but on the chart. And price has a tendency to behave in the same way that it might behave when we drive across a plain and then hit the mountainous region. Price tends to gravitate towards the hills and move very quickly or get rejected by the plain. Well, the rejection part, I can think of that. I had an experience last year. I went out to Southern California, and we visited the desert. We went out to Anza Borrego. I think that's what it is. And when we went out there, we were heading out to the desert. There was these flat plains, and it was wicked hot. I mean, it was 115 degrees, and we're thinking to ourselves, man, I hope to hell that our car doesn't break down, because we've been driving for like 15 miles, and if we break down here and there's no air conditioning or anything, we are done for. So, you might think that way and then say, well, screw that, I ain't going out there. And then, or drive as fast as you can until you get to that next area where there's at least some vegetation. I don't know if any of you have ever experienced that, driving out in the desert, but it is quite an experience. It was the first time I've ever been out in the desert, because you can literally be driving for 15, 20, 30 miles and there's nothing, just flat and hot. I mean, so hot that you get out and it's hard to breathe hot. And particularly in a high plains desert, which we were in, which was 5,000 feet above sea level, and the air is wicked thin on top of being hot.
Well, I live in Southern California, so.
All right, so you know what I'm talking about.
Oh, yeah.
So that's the way I like to look at, the volume well and the volume nodes. All right, so what we're going to do now is I'm going to go back to the chart. Oh, you know what we're going to do now? This is where I normally will take a break. So we're going to take a break right now for about 10 minutes. And then we'll get to talking about the whole strategy and how I actually mark up the chart and how I use those markups to create trades. Okay. Any questions before we do that?
No.
All right, great.
I'm glad to be here. This is very, very good stuff. So
appreciate that. And remember, we still have the coaching session, and we can go into a lot more depth and strategies and stuff like that too. So, and also I provide any kind of support that you need, so you can pretty much call me anytime. Just don't abuse it. Like I tell people, you know, you can call me anytime, but if you start calling every day, I'm going to probably block your number.
Well, you've got clients you work with and other people, and I'm just trying to learn. So I'm gonna, once I get into it, I may call you a little bit. You know, just
oh yeah, I don't mind that. I don't mind it at all.
Still in the infancy stage right now, so I'm
So
gonna
okay,
get a cup of coffee.
I'm gonna stop the recording right here, and we're back. And I'm gonna bring up a chart. And describe my methodology on how I would map out any asset. I mean, we're going to be looking at Bitcoin, and that's all well and good, but this would apply to virtually any asset. It's all basically the same thing. It works with any stock, any futures product. Doesn't matter. ETF.
Do you trade Bitcoin futures?
I do. I trade the CME Bitcoin futures. All right. So, like traditional trading, I do everything in multiple time frames. And as I had mentioned at the beginning of this training, I said that you should be concentrating most of your strategies in the longer time frame. In fact, I want to sort of harken back to, you know, and illustrate this. There is a series of books that were written by Jack D. Schwager called Market Wizards, and I would recommend them very highly. It's there are about 6 books in the series, but what they are interviews of the most successful traders in the world. And there are 2 things that can be gleaned from the most successful traders in the world is that, one, virtually all of them are long-term or trend or position traders. Some of them also do some swing trading or shorter-term trading, you know, based on their strategies and market events and that sort of thing, things that they've identified and identified a hypothesis around. The other is that they all basically do whatever they do in a unique way. It's their thing. They don't follow the crowd. They don't follow what are the standard tenets of trading, or they've found their own edge by examining the fundamentals of whatever industry or market that they're into, and discovered that edge, and then they exploit it. And this seems to be the hallmark of virtually all traders. Now you can step on top of the shoulders of somebody that already has an established strategy, and then build off of that, and then try to make it your own. And that's usually the way most newbie traders do it, if they don't get stuck into this whole broker narrative paradigm that I was talking about. But ultimately, that's where you're going to find your success. Things that you know about and that you've examined and found what you believe is an edge that you can exploit. And that is what is illustrative of these market wizards. They all do it their own way. They basically are all long-term traders with a smattering of medium-term and short-term. So they mix it up when they feel like they've got an edge. Some concentrate on medium-term, but virtually none are short-term traders. So that should say something. The most successful traders in the world, none of them are short-term traders. That's just a fact. And there's a reason for it, because short-term does not provide opportunity. And the risk is too high, and the return on capital is too low. I know a lot of people don't like hearing that because they want to, damn it, I'm going to beat the market. no matter how much it's rigged against me. And that's another thing that you need to come to grips with, is that the market is manipulated all the time. Every market, every asset, they are all manipulated. And that's just a matter of life. If you had enough money, I guarantee that you would be trying to manipulate it as well. All right. So what we're looking at is a little under a year. Let's take a whole year of Bitcoin. This is just about a year right here. And this is a daily chart. And generally what I do is I work in 3 different time frames. And the longer time frames, I put more relevance on those, because those are the more meaningful time frames. That's where most of the stuff has happened or it gets revealed. And less so in the shorter time frame. So if I'm trading in the shorter time frame, I want to still have the information from the longer time frame visible. So that's why I always start with the longer time frame. And the way I map out the structure of the market is pretty simple. First of all, we have the POC, and by default, it seems to come out as a red. So I've chosen then to highlight all the high value nodes with a red line, a red horizontal line. So that's what I'll do. I'll create a red horizontal line on the high value nodes that are right near me, and maybe even the ones that aren't so near me. Now that one I created was dotted. I don't like them dotted. I like them solid. Unless, in general, what I do is, if I feel that the line is from a longer term time frame, it has more relevance. So I'll make it solid and about as thick as I can get it. And if it's less relevant and maybe less or weaker, then I'll make it thinner and maybe even dotted. So that's what I've done here. I've made this, nice, thick and red. I'm going to hold down the control key, because I believe that's a feature that's available on most platforms, and click and drag the line, and then that will clone it. And then I'll do it for this one down here too. On my platform, it also brings up a menu for some reason, but that's okay. But all I did was click and drag it with the control key down, and that clones it. So now I've made, go ahead.
So how do you, sorry, I missed quickly. So how did you get the lines? From where did you get from the menu?
On the upper left-hand side, if you can mute yourself, we're getting feedback. On the upper left-hand side, we have a toolbar, and the second from the top tool are all the drawing tools. And if you click and double-click on it, or click twice, you can choose from any of these different types of tools. And I chose the horizontal line. And then you can choose to select it, and then drop it somewhere. Like I'll drop one right here on this value node. All right, you got that? So if I wanted a different line, then I would have to sort of double click on it and get the menu, and then choose the different type of line that I want to create. Like if you want to create a trend line, then you could create the trend line and maybe draw a trend like this. I'm just going to delete it now. But if I want to go back to the horizontal line, I have to double click it and then select horizontal. All right, so the next lines I'm going to draw are the volume wells. Those are the areas where it dips down significantly. And I like to make those blue. So I'm going to make them blue. I'm going to make them a cyan blue. And then draw those in. And this is a big one right here. I would even consider this big drop-off right here as kind of a well right there, because it's such a big chasm. And maybe one right here. All right. Now I want to say something about this this bubble, in case you ever encounter another bubble in another market sometime. All bubbles are pretty much exactly the same. They follow the same pattern. And one of the ways that I was able to make a lot of the calls that I made over the past year or so is because of my recognition that we were in a bubble. And even before it even went into this hyperbolic move, I knew that we were in a bubble. And the way I knew that was we started to increase price exponentially. And then we had this big dip here. And then we recovered from it and continued. At that point, that was my confirmation. But I was in a strong suspicion we were in a bubble even before that dip. That dip right there is called the bear trap of a bubble. And just so you know, I'm not talking out my butt here, but there is actually a thing of anatomy of a bubble, and that they all exist in the same way. Let me just say that all bubbles, they have this bear trap followed by a blow off top, and then a secondary top, and then capitulation. What some of these graphs that I'm about to show you don't show is then that usually is followed by a series of descending bounces. The first one, a lot of people call this a dead cat bounce, followed by another one and another one and another one and another one until it kind of settles out, and eventually will gravitate towards or start trading around the long-term trend line from the very beginning. So, for instance, if I would have, really just squished this way up and drew a longer term, I'm going to actually use a regression trend and drew it from way back here in 2016. I could even go further back. Let's go way back to the beginning. Well, this one only goes back to 2015. All the way to today. This is going to create what's called a regression channel, but that all I'm really concerned about is that middle line. So I'm going to change its color a little bit to alter it. And also I'm going to change it to 1 standard deviation. Right now, by default, it's set to 2. I don't really care about the, then I'm going to change the colors. The base, I'm just going to really dim them down by changing the opacity. I'm just doing this so I can see that middle line. That's all I really care about. And now I'm going to expand it again so I can see what that middle line is. Now, you can see it here. It's kind of crossing up this way. That middle line is somewhat significant. And it's going to be a little bit different on each chart. There are some charts on Bitcoin that go back even further, and you'll find that that middle line tends to dip down. But if you were to draw a regression channel on some other commodity like gold, you'll find that that long-term regression line is generally where gold is following in the long term, even though it's had some bubbles and dips and other things. But in my view, that's probably generally where Bitcoin is also going. Right now, it's set at about 7,900. But if you were to choose some other charts, some longer-term charts that go all the way back to 2011, you'll find that that value is actually closer to 5,000. And that actually represents I guess, the true value or the long-term value of whatever commodity that you're looking at. So I'm just going to use that as just an illustration. I'm going to delete it now. These are things that I look at. Another thing I'll look at is, this big price action in the form of a bubble. And I'm going to go back a little ways to about one total year. So now, here's one total year. And like I said, all bubbles follow the same pattern. A bear trap followed by a blow-off top and a secondary top, capitulation, and then a series of degrading bounces. Much like if you took a rubber ball, and rolled it off a table, the first bounce would be big, the second bounce smaller, and the third bounce, and so on. Virtually all bubbles behave exactly the same way. If you go back and look at every other bubble that's ever been created, it has this same basic set of characteristics and pattern. And to show you that, there are people that have done these kind of things where they give anatomies of a bubble, and they showed that exact same thing. The bear trap followed by the blow-off top, the secondary top, capitulation, and then what they're not showing here, the dead cat bounces that usually follow. But in my experience, that's how all bubbles. Now, the only difference between them is that some of them are thinner, some of them go up higher, some of them are broader, but they all basically follow that same pattern. So I use that as a backstop and as a guide as I was doing some of my analysis, with this. I think that's important. The other thing that I use, remember I said I'm not too keen on technicals, but that's not entirely true. If I think that something has a statistical advantage, it would be dumb not to use it. So I will often go and look if there are certain patterns that do have a statistical advantage. Now, I don't look at all candle patterns. I only look at, or chart patterns. I only look at those things that I think have about a 2/3 probability of occurring or better. All right, remember I said that 2/3, that was kind of your bailiwick. That's what you're using as your general measure. And one way I do that is by going to a site called the pattern site. Let's see if I can get to that. Do I have a... Oh, here it is over here. The pattern site. This is a site that was developed by Thomas Bukowski, widely regarded. And what he did was he's developed all this information on patterns, chart patterns and candlestick patterns, over millions of charts, millions, and developed statistical data and contextual data. So in other words, the patterns under a certain context, and then rank them all. Now, the ones that I'm interested in usually are candlesticks. So I'll go to candlesticks. There's Tom Bukowski right there. And I'll go down to the very bottom here. Here he has the top 10 overall candlestick performers. And so what I do is, here they are right here. If I see one of these candlesticks that are the top performers, I'll pay attention to it and then add that to my analysis. Now, again, the reason why I do this is, and also, but it has to, really follow the candle pattern, and it also the context around it. It's very important. And this is in the same regard that I treat things from a fundamental point of view. I also have done a fairly extensive fundamental analysis of Bitcoin, from a big industry analysis to the regulatory issues, to the amount of people that are interested in it or not interested in it, the institutional involvement, and I munge all that up together to give me my bias. And my bias says that, at least for me right now, I'm 80% bearish, 20% bullish. So basically that's telling me that I'm only interested in bearish moves. I would be stupid to try to pick off bullish moves because they're likely to go against me, until the market turns in such a way that changes that fundamental narrative that I've developed. Remember, I said this in the very beginning. It is really important that you put everything and stack everything on your side, develop a fundamental idea or analysis of where you think the market is and where it's going, and use that bias as the guide for all your trades. So, and also remember what I said, that the long-term traders, the trend traders, and the position traders tend to be the most successful. So I'm going to trade with the trend. And I do this with virtually anything that I'm bringing in as my my next trading thing. So let's say I wanted to trade gold or the S&P. I'm going to do the exact same thing, bring into it the fundamental analysis or even an individual stock, develop that bias, that long-term bias, and then when I trade, my position trades, my swing trades, and my short-term trades, I'm only going to trade in the direction of that bias. And I'll use things like these candlesticks, if I notice them, to give me maybe a potential entry that will confirm that bias or that narrative that I've developed. Hopefully this is all kind of sinking in. You know, this is part of the overall methodology. So again, now I'm using volume profile as all part of that methodology because I've got that discovery that this is how the traditional traders, and this is how even the professional traders to this day do their analysis to determine where the demand is with volume profile or order flow. This is another way of looking at order flow. And they decide, you know, where price is likely to go. So now the next thing I do is, like I said, I use multiple time frames. I tend to use the daily, the 4-hour, and the 1-hour time frame. That's my long, medium, short time frames. And so the next thing I'll do is I'll go down to the 4-hour time frame. And I can still see the lines that I drew from the daily time frame. So those are all significant to me. But now I can see other nodes that should also be significant in value wells that are significant to me. And I can draw those in. Now I'll draw those in with skinnier or darker or thinner lines because they're in a smaller time frame. So let's say that I double click up here and go to my horizontal line. I want to draw some more value nodes, but these are in the shorter time frame. I want them to be red. Maybe I'll make them maybe I'll keep them red, but maybe I'll make them less thick. Maybe even thinner, like this. And then draw them in. Around where the price is.
Oh, quick question. How did you copy the lines quickly?
I hold down the control key and click and drag. So if I wanted to copy this line here, can you mute yourself, please? If I wanted to copy this line right here to say this node, I would hover over it and I get this little hand, hold down the control key, and then click and drag it. And then that creates the new line. It clones the line. All right. So we can see that the features down here, I can probably create some these volume wells. I can add those in. But I want to change their color to cyan, maybe a slightly darker color of cyan. Maybe like that, just to differentiate them. And I'll plop them in there, maybe one there. And then I can also right click on it and clone it as well. That's another way. You get this contextual menu, it'll clone it, and then just drag it into place. Right there. And maybe one down here. And then definitely one like right around, usually at, you know, you can choose the lowest point in the well, but sometimes the edge seems to work well too. Because that's such a severe drop-off. It's hard to discern, you know, where it's going to be support and resistance. I would say it's going to be somewhere between here and here. Some people might opt to draw a rectangle in there even, but I don't do that. I just like having my lines there. So then I'll go down to a 1 hour chart. And it may or may not be necessary to draw anything from here. But you might want to refine where you think those lines are, or say, hey, man, there really should be a value node here. The reason why this changes is because the what's actually coming into view is different than what was in the 4 hour chart. There was more information in the 4 hour chart. So I'm getting more detailed, more recent information in this 1 hour chart. All right. So now, how do I go about trading? Well, in my world, like I said, the fundamental, my fundamental analysis, at least with Bitcoin, is that price is going down. So I'm going to use this arrow just to illustrate this. Here's the direction of price, the general trend. So I'm going to be looking for just short trades. And where I'm going to look are at the edges of volume wells. For the most part, that's where I'm looking. As a general rule, I'm looking where price will go up to. So like this might be a good area right here, this one right up here. There was a definite volume well right there. So you can see price rallied up to this point, hits this volume well and gets rejected. Hit it again up here, although it's not quite clear. It did come up almost up there, right about here. That's why I say sometimes these edges are good indicators where to put those lines. These are only guides, by the way. But you'll see that it has hit that several times. It hit it once here, hit it here, almost hit it here. Down here, we hit this volume well right there. Now, this red line right here, it doesn't appear to be a value node, but that's because it came from a chart that showed more information. So it still exists. Now, the way I'll take trades is I'll say, okay, if we're going to rally up and hit one of these volume wells, area resistance, that's where I'm going to take my short. And then I'll target a value node. Now, someone could look at these and say, well, you know, in a short-term time frame, it's really hard to discern exactly where I'm at, you know. One could consider this entire thing one big volume node. You know, and maybe I only wait for trades when it pops up to the edge up here. So I would have had essentially 3 different trades. I would have a trade here, here, and here. Now, of course, in this 1 hour time frame, I wouldn't have seen this node right here because none of this data would have existed when I was back here. So that's why you develop all these multiple time frames. It's a little easier to see here that some of this volume, some of these nodes actually were originally created way back here. And those same features then get repeated over here. This may add to the texture of that market and start building it up. But we can use those older ones as guides. Now, over time, in analyzing this market, I've started to develop a hypothesis. And that hypothesis is right now, until the fundamentals of this market change, there's going to be manipulation where we're going to rally, and then it's going to decline after that rally, which it has been doing. Some of the rallies have been sustained and then they decline, but virtually every rally beforehand has provided opportunity. Sometimes not the perfect opportunity, like for instance, this one right here. It rallied and you would think, okay, I'm going to take a short here. And it came down a little bit, but maybe not enough to take a trade. Then it came up again and again and again. And then finally it came down. How do you deal with situations like that? Now, if my analysis is to short every rally, yet it kept on rallying and I kept on shorting, you would think that eventually I'm going to get wrecked, you know? I mean, I'm just adding way too much to this trade. And that would be true if you trade like everybody else. But if you trade the way I suggest, and that is that you break up your full positions into small tranches, and you wait for that trade to fully develop and only add those tranches as that trade develops. So here, what I did in actuality was I did take a short right around here, but with only a quarter, actually in this particular position, only a fifth of my full position size. And remember, my positions are generally small anyway, so a fifth of my position size is way, way smaller than most people's position sizes. So that if it goes against me, I'm not hurt. As a matter of fact, I'm almost expecting it to go against me. If it doesn't go against me and then shorts, then I get a small, nice little win. But if it goes against me, then I'll add to that position and maybe add another fifth. Now I'm 2/5 into this with a position here. If it goes against me again, now this may not be as much of enough to go against me, but maybe this one was, and it was. I added 2/5 of a position size. Now I was into it 4/5 of a position. And every time I added higher, my cost basis of getting into that trade raised up. See, I wasn't able to predict exactly where the top of this was, but by adding to that position, I can approximate that, and my overall position starts raising up because I'm adding more to that trade. I added 1/5 here, 1/5 here, 2/5 here. That raised my actual position size up to just around here, which isn't perfect, you know? I mean, I didn't catch the top. I didn't have to catch the top because I didn't know where the top was. I'm fully expecting to add another tranche maybe up here somewhere. But it turned around on me. And it ended up with a 4/5 position size, making an excellent trade. And I'm using the volume profile in general this way. I am looking for to trade around these volume wells because that's where price tends to get supported or resisted. So you can see that right here. Here's a volume well. We have unbelievable resistance right there. Over here, you can see it tries to come down and it has support. Now, these volume wells aren't perfect. Like I said, that they're wells. They're not, pinholes. So it's an area of resistance and support. Keep that in mind. So you can be a little bit more flexible with your trades. You can see that if you're going to, like right here, if you wanted to take a short, this would be a really good place to take a short anywhere on this volume well. And you'd be prepared to take more short as it rose up, maybe rose up here or up to the next volume node of volume well. If your long-term position was that it was going to go down, eventually you would be right. Now, that's not going to happen all the time. Maybe 80% of the time, because you're 80% bullish, it's going to happen. 20% of the time, there's going to be a point where it's not worth following the trade anymore, so you get out.
Quick question, Ernie.
Sure.
So are you saying both volume node and well are the areas of support and resistance, or just volume of just the wells?
In general, the volume well is the area of support and resistance. In fact, if you go and you do all your trend line analysis and moving average analysis, you'll find that in general, all the support and resistance occurs at the significant volume wells. And it's very easy to see. I mean, you can go back and look at it. You can see that this provided resistance right here. It provided support right here. And remember what I said, that price has a tendency to want to move very quickly through these wells. So once price broke through this area here, where there's probably should be another line right here. Once it broke through there, it moved very, very quickly. Now remember, this didn't exist here. That little node didn't exist when it went up. It moved very, very quickly up to this next volume node and targeted that. So it has a tendency to either get rejected by the volume well, or move quickly through it and try to find another volume node and then use that as a target and then consolidate. That's generally how it's behaving.
So what you're saying is the volume node is where the target is?
That's right. That's right. So you can use the volume wells as your jumping off point, where you take a trade from, and your the nodes as logical targets. Now, it gets a little bit more involved than that, because there are a lot of different patterns that happen inside, volume profile that you start recognizing. One of the patterns that you'll recognize a lot is a major node being created, and then a minor node, and then return to the major node. Now, in this particular case, it actually created two minor nodes, so that's not a very good. But let's say that this was a major node right here, and we could like illustrate it by creating a fixed range there. Nice balance, fairly well-formed balance. Well, it's not really that well-formed. It's kind of lopsided balance, but once it broke through the top, it came up here and created another small balance. This is a common occurrence where you have a big balance and then a small balance. And what tends to happen is you'll go from the value node of the big balance, create a small balance, and then often will come back down to the POC of the previous balance and then move right through it to the extreme. That is a fantastic pattern to note. Now, it didn't happen here, so it wouldn't have worked. But there are patterns like that that happen all the time, where you have a major balance and then a child balance that play on each other. And all I'm telling you right now is that you should look for things like that and then record them and then see if you can see a pattern that happens within that particular asset, because that often will expose really great trades. Now here it kind of did a dipsy-do. It did something more like this. Or maybe this was just a temporary respite to this child balance up here. Right? Maybe that was more like what it was doing. So you had the big balance, then a smaller balance, then moving down through it. That pattern, and maybe in a different time frame, that would actually look more like that. So maybe in a daily time frame. I could expand that. It's a little extreme, but it happens a lot. It's a pattern that I look for. It hasn't been happening in here, but I'm just pointing it out that there are patterns that happen quite often with these things where you have major balances and then smaller balances. And they tend to play off each other. Now, one of the things that
Can you show an example of it?
yeah, I'm not seeing any good examples here, but let's see. So I guess this might be one right here. Where you have a balance here. And it comes down and creates this balance. All right, so we come here, we move out of this balance with a strong trending move, create a smaller balance, and then move up through this balance to its extreme. That is an often occurring pattern in stocks that I know of. Doesn't look like it happens as much, but I wanted to point it out because it is something, and I wanted to also point out the idea of looking for these types of patterns. Where you have big balances and small balances that play off of each other. And the way I illustrate that, and one of the things that I do that once I've sort of mapped things out like this, and I'm looking for these types of patterns. Well, let me give you an example of, beyond going just looking for these types of patterns here. Remember I said I'm also looking for statistical patterns, candlestick patterns and such. So I'll just get rid of these for now. Now, when we came down on this capitulation move on the bubble, we came up and I didn't know where this top was going to be. I had a couple of different indicators. We had a little chart pattern here that some people look at as a reversal candle, but it wasn't clear. And I did take a short there, but it didn't pan out very well. It was okay. But we came up for this other pattern here, and we created a pattern here that's kind of hard to see. But if you look at these two candles right there, I'm going to expand this a bit. These two candles right here, big down candle after a lot of big up candles. Now, the interesting thing is that this is a 24-hour market on Bitcoin. And so it's hard to discern, where the beginning and end of these sessions are. They arbitrarily choose 8 o'clock at night or something. But most of this downward action right here occurred right at the end of this session and then continued on in this session right here and kept on going down. So in effect, this is like one continuous move from here to here. Now, if you were to look at that, what it does, that one big continuous move from here to here engulfs this up move, and this up move right here. That's pretty significant because that's a pattern that I identify with in the pattern site. And I'll show you that. That's this one right here. Number 2, the 3-line strike. Now, it says it's a bullish pattern. That's what most people call it, but Bukowski calls it out actually as a bearish reversal. And it is a bearish reversal. I've used this pattern many times in many different instances, and I've published videos on it. In fact, I published a video on this particular one, too. Unfortunately, that was before my YouTube channel was deleted by some nefarious people. So the channel that you're viewing now, I started on May 15th. The channel I had prior to that was started 9 years prior, had 1,100 videos, and that was one of the patterns that I had pointed out. the three-line strike. I saw it. I recognized it as being a three-line strike. And the cool thing about this particular pattern is that it has a high degree of probability of occurring. As you can see, 65% chance of it occurring. And it has a huge return on capital on average, a statistical average over all the charts that he's examined, which are millions. And it's the number 2 of all the candlestick patterns that he has examined. So if I see that, I want to act on that. Just in the same way, if I saw 3 black crows, I'd want to act on that as well. Well, it just so happens that we had both of these in succession, a 3-line strike followed by 3 black crows. And we can look at that right here. So again, here's the 3-line strike. As I said, this is really one continuous pattern, because if you looked at it in a shorter time frame, you would realize that this started moving down and never stopped. It picked up right where this one left off and kept on going down. So as far as I was concerned, that was one long move down. Then, so at that point, I made the call that was a 3-line strike. We can expect a huge downturn. And we did. We had a huge downturn. But look what it turned into. It turned into 3 black crows. I'll go back to that again. The number 3 pattern. It went from the number 2 pattern to the number 3 pattern. The most highly statistical patterns with the greatest amount of follow-through of all the patterns that you would look at out of 104 different patterns that he looks at, that he examined over millions of charts. That's number 2 and number 3. Happened in succession. Here and there. So I made the call that this was going down hard. And it did. It went down hard. Now, all the while, I am also using the volume profile to confirm these moves and where I thought that they might end up, So I chose, targets that were coincident with the volume profile in the longer-term time frames. But I use those in conjunction to sort of give me the impetus or the confidence that these were excellent places to take trades. For one, it was at a low volume node, or a drop-off point of the value node. And on top of that, it had huge confirmation with this 3-line strike. And then a continuation of that to add more to that trade because we had 3 black crows. So this is how I use the volume profile in conjunction with highly statistical patterns.
Quick question. So you said take the trade at the volume well, but where's the volume well where you took the trade?
Well, the first one I took was right here. There was a volume well right here. This big drop off right here. That was huge volume well.
So, I mean, where the well is, at the very bottom of the well is, a little bit further up. So where do you set up the short point? I mean, it doesn't, always correlate exactly to where the well is. It could
it doesn't.
Before it or after it. So how do you set it up?
So there are a number of ways, and you can do it in different time frames, but the way I look at it is I'm looking for confirmation on a number of different things. Here, I saw that it hit this volume well, got rejected by that. Now, I didn't immediately jump out of my seat and then put the trade on. But what I saw was what looked to me like a reversal candle, and that's what this is. On the pattern site, this could be considered. It's not really an evening star, but it's very similar to an evening star. So to me, that had a fairly high level of degree of confidence to take that trade there. Hit the volume well, got rejected. My overall my overall position or fundamental analysis or narrative is that we have a bearish narrative. And so I took a trade here. All right. And it panned out okay. I mean, it was a fairly decent trade. You know, I mean, 1,000 points, fairly decent trade. When it came up here, I wasn't so sure again. It did hit this volume well again. And I was ready to take a trade. But then I saw this big, huge candle here after it hit that volume well. That gave me the confirmation to go into this trade. I went into this trade right here.
I guess the problem that I had in the past is like finding the precise point where to take the trade. Sometimes, you know, you map out a precise, you know, point where you want to like short or buy, but it misses it by a little bit.
Yeah, that's a problem though, isn't it? I don't have that problem. I'm not looking for that. I'm not looking for that precise point. I'm looking for areas where I know that there's support and resistance that I could comfortably have added a very small position here, right? Not my full position, but then I get confirmation and I can add to it. Then I get further confirmation, I can add to it more. So that's a fundamentally different way, and I think, well, this is actually a professional way of trading. You leg into the trade. You find a place where it looks like you have a fantastic opportunity. So you don't go and you don't blow your wad on that position. You leg into it. Like I said, I usually leg in either 3 to 4 tranches, sometimes 5.
So what you're saying is, let's say instead of trying to find a precise point on the well to start your position, maybe you'll just
1/5 position size, like right up here somewhere.
Just trade a little bit at around that area.
That's right.
And then when there's a confirmation, you would add another position.
Yes.
And another position.
Yes.
That's what you're saying?
Yes. That's exactly right. And it you know, I could have used it in either direction. I mean, this was like a no-brainer because of the high degree of confidence I had in these trades, but it could have gone against me too. And I would have added those positions there as well. Because my overall bias is still negative. I would expect that at some point I would be right. Here, I was right, but I didn't know how right I was. But it kept on confirming that I was more and more right, so I added to the position. And it ended up being an excellent trade. Now, all along the way here, I was analyzing all this via volume profile. It's a little difficult to look at this in retrospect because we have all this extra information and it adds to this. But I can show you where I was in all of this. So I publish, you know, my ideas in TradingView. Actually, it started right here. So here it is, right here. 3-line strike on March 7th. So I had originally called that 3-line strike there. After that point, on March 8th, it started to move down further, and it started to develop into this 3 crows. It hadn't fully developed, but what I started to do was map out where I thought the potential path would be. Now, my idea was that it would probably move down to this volume node and then consolidate there. All right. And so I even drew in where I thought it would consolidate, including if, in fact, we had diminishing volume over that consolidation, that would be another good indication that it was a consolidating move. And I thought that it might move up and retest this other value area up here and then continue down. So if we look at that, and this is without removing any of the arrows, I mean, these were all the original arrows, you can see it pretty much followed that path. Now, I'm not saying that I'm going to pick off these paths every time, but I can create a path, and I usually assign, I'll do both, you know, what is the positive path and the negative path. These days, that's what I do. I set it up so that I look at both my bullish and my bearish idea, and then I'll put a percentage on it. Let's see if I can show an example of that. Is this it? Maybe on my desktop. I do this every day, so I'm often showing yeah, right here. I don't know. Can you see what I just popped up? I don't know if I'm showing that clearly. So I'm going to stop my share, and I'm going to show just that. All right. This isn't showing the volume profile, but I removed it for a bit just for clarity. So as I plot out my profiles and my lines, my volume wells, and my volume nodes, I will assign, as I'm going along, the path that I think it's going. And actually, the white path is where I thought it was going. That was my bigger prediction. And then alternate paths, and then the percent that I think that it will do. And that's how I choose my trading. And I update it as I go along. I try not to change the things in the past, because that shows me, you know, how good or how well I am performing. And I will then go and I'll look at that at the end of a campaign and see how well I performed in terms of the analysis and my trading. And then, you know, use that as kind of my knowledge base and learn from that. So as I'm going along, you can see my thicker lines are my favored path. And, you know, I was lucky enough to choose those. And they panned out pretty well. So that's generally how I do these things. But in terms of, you know, your question and, you know, how do you pick off precise points? I do not pick off precise points, because I think it's almost impossible to do that. And that's why I pick off ranges that I'm interested in, confirmation from high probability patterns. And then I step into them a little at a time. And then when they confirm, I'll add to them. If they don't confirm, but I still think that the trade is on and they go against me, I'll add to those as well. And until they get to a point where either they're obviously not good trades and then I'll get out, or I've put myself into a much better position and I can realize a much better return.
So, do you have some sort of like a stop loss point where you feel like, hey, enough is enough?
Okay, so remember before I said that I don't use stop losses. The way I manage risk, now Bitcoin is only one of the things that I trade, and one of the reasons why I trade it is that it has a very low degree of correlation to virtually every other asset out there. And so it is one of the things that I trade, but it is only one of the things and one of the strategies. I trade other commodities and other stocks. And each one of them, I have different strategies that I run, and I trade them all simultaneously. So I'm short on some things, I'm long on other things. That is how I contain my risk, by hedging my positions. Also, some of the trades that I do are what you call statistical arbitrage. I don't know if you're familiar with that, but it is literally going short and long with two very similar things. And what I'm playing is not the direction that they're going in, but the relationship between them. So for instance, I'll trade the difference between platinum and gold, or the difference between heating oil and crude oil, or the difference between the, I'm getting a little more sophisticated here, but just so you can get an idea, the difference between a 30-year bond and a 10-year note, known as the notes over bonds trade. And I'll be going long and short on highly correlated things to see their or play the relationship between them, because that relationship is fairly steady, and then every once in a while it gets out of whack. But those trades then by themselves are uncorrelated to each other. So my notes over bonds trade is uncorrelated to my metals trade, which is uncorrelated to my energy trade, which is uncorrelated to my technology trade, which is uncorrelated, I hope you get the idea, uncorrelated to the Bitcoin trade. That is how I contain risk, by trading all of these at the same time. Then, and by not committing too much to any one of the trades, and only committing when I know that those trades are going in my favor. That is how I contain risk. Now, of course, there are some cases where a trade will just go completely off the edge for me, and it has nullified my hypothesis, my idea, and then I'll make a judgment call on that, and I'll get out. But it's not like I'm getting out because, man, it's killing me. I get out because it's just not following my plan, and it doesn't kill me because my position size isn't that great with it. Now, I'm positive that this is fundamentally a different way or a different idea from the way you've been trading. But I'm telling you that this is the way professionals trade. This is the way a hedge fund trades, an institution trades, a professional prop trader trades. And it's also the reason why I said that, in the beginning, the advice from my mentor, who was a very, very successful trader and made about $100 million in his career. And he said to me that trading is the hardest way to make easy money. Because once you get the system down, once you get the idea that you need to trade multiple non-correlated strategies, once you get the idea that you have to trade really small and leg into things and preserve capital above making profit, that's when you start making money. And it actually becomes relatively simple in a very complex system. It's not so complex. I mean, to draw it all out, it's not that complex. I mean, you can start with a few strategies and work with that. Start trading small and work at using the strategies themselves, the difference between them, the diversity of them as your way of hedging. By putting small positions in, you're not going to lose sleep overnight if it goes against you. You know, I can be fully invested and I can go to sleep at night not worrying about even if there's a market crash. I might drop 5% of my capital, maybe 7%, but I mean, I'm not sitting in the same position that other people have dropped 30, 40, 50%. And more than likely, I'll be out of that position long before I ever reach those types of numbers. I hope that answers your question. And that's why I'm not so concerned about the specific area that I'm getting into a trade. I'm looking for areas that I get into a trade because they conform to my fundamental narrative and because that trade is non-correlated with the other trades or the other strategies that I'm doing. And so it's a good bet. If it goes against me, I'll stay with it. I'll add to it. If it goes with me, I'll add to it. Either way, I add to it. If it's going with me, adding to it just enhances the trade. If it goes against me, I'll add to it until it doesn't work anymore. But if it's fitting inside of my big narrative, it probably will work for me. Where most people are failing is by setting stops and getting out of the trade, and then it eventually turns around and works for them again. And they wish they were still in that damn trade. And then that causes them their emotions to go haywire. Wondering, well, why couldn't I have stayed in it? Why couldn't I have added to it? It's because you don't know where things are going. So treat it like you don't know where things are going.
That happened to me many times. It would stop out and then it would go with my original plan. And then just psych me out.
Well, and because you overcommitted in the beginning, it made it impossible to recover. If you hadn't overcommitted in the beginning, if you took every trade like you have no idea where it's going to go, you have no idea where it's going to go, and that you're going to test the waters, and then once it starts proving its way, that you add to it, or you have a fairly good idea that the overall market is bullish, or bearish, that it's just in this kind of reactionary mode or defiant mode, that that nothing in the fundamental analysis has changed, then eventually it will come back in line. By not overcommitting and by adding as it gets closer, or a better, and what I would consider a better and better trade, you're improving your cost basis each time by adding, that eventually it will come around because nothing has changed in the fundamental analysis. Nothing goes against the fundamentals, ultimately. In the short term, they do. They often go against it. In the long term, they don't. And that's why it pays to stick with it. But it doesn't pay to overcommit.
So what is your view of the S&P 500? You think it's bullish right now, or just sideways, or bearish? What is your...
Yeah, so I have a very different opinion from most of the, I think, pundits that are out there that are talking about it. Which, by the way, most of these pundits and CNBC analysts are not the professionals. By the way, they're out there trying to stir up eyeballs on their network. But I think that we are right now, based on my fundamental analysis, based on my analysis of the relationship from stocks to bonds, that we are currently in a breakout of historic magnitude. That we are at the precipice of what looks to me like the largest bull run in our history. And if you go back and you look at similar relationships between stocks and bonds and other areas where it has broken out, it's a very, very similar pattern, only this pattern is much bigger than all the previous patterns. And so I believe that we're on the precipice of a multi-decade long bull run. Now that is pretty much contrary to what most of the other quote professionals are saying. But according to my analysis, I think that we can pull back, and I think that we can even drop into small recessions or pullbacks, but nothing major. I think we're heading towards the type of bull run that we haven't seen before. There's a really good YouTuber that I would point you to that has had great success in this area and has done fantastic analysis of this very, very, I came across him because I was looking for confirmation on this and found this guy, and he explains it way better than I can. And his name is Chris Shavako. And I will point you to his channel. It's called, I think it's called Shavako Capital, but I'm not sure. Yeah. There it is right here. He's got a good Twitter account too, but I would highly recommend checking his stuff out. Actually, this might be one of the places where he talks about it. This video here, tired of making the same investment mistakes. But he does a lot of analysis, very similar to the analysis that I've done. And like I said, I'm constantly looking for those relationships because those show the true nature of the market, the true feel, or the true, relationship is the best way to say it, between stocks and bonds. And right now we are on the precipice of, or we have already broken out of, about a 17-year consolidation between stocks and bonds. And the last time this happened, or every time it's happened in the past, we've gone on huge market runs, multi-year market runs. And this is the biggest consolidation breakout that's ever happened before. So that's my view on the market.
What was his last name, Chris?
Shavako, C-I-O, let's see, I don't have it. Let me put it up here on the screen. Here's his YouTube channel. He also has a Twitter channel that you can get to right off of his YouTube channel. There's a little link here up in the banner. But he does some very rational, insane analysis. And I would highly recommend looking at his stuff and a lot of his historic stuff.
Sorry, I digress a little bit, but yeah, maybe we can get back to volume profile. So.
Yeah, well, the reality is that the only other thing that I would like to show you are some of these templates that I use to look for patterns in the profiles. Let me go back to the just give me a second. So what I'll do often is I'll create these kind of templates. And when I see patterns, this is one idea. When I see patterns, each one of these represents like a balance, as you can see. And then these cyan rectangles represent the low volume wells. And I'll recognize patterns, and then I'll draw them out. So for instance, this is one pattern that I see happen a lot where if like the trend is up, taking a trade from one extreme of the value node to another, and then taking profit there, and then often a short then from the extreme back down to its POC is a pattern I see happen a lot. Here's another pattern that's almost like the inverse of that, and that is from the if you see it going from the POC to the extreme and then start heading up through the POC again, often that is a good indication that we will be going from breaking out of that and breaking out through this volume well, and then going to the child point of control or value node. So there's a trade that you can either take right from here, and if it goes through here, this is sort of confirmation. Goes through here, it's additional confirmation, and then here's a target. This type of thing happens a lot. And then again, I'll create, you know, other types of things where I'll look for different types of patterns that would happen depending on the trend. And I have a whole bunch of these, you know, I map these out. But, you know, the other way I map them out is just as you saw in that, this screenshot. This is something that I do more often, where I project where I believe things are going and the percentage of it's going, percentage I believe that it's going to follow based on my overall fundamental analysis. And then I'll make the thicker lines my favorite path. And so that's what I've done here. So you can see the big white thick lines. That was my favored path. And for the most part, I've been right. But, you know, that takes a little bit of time, a little bit of experience once you start getting into this, and not putting a lesser degree of emphasis on the fundamentals. This is where I think most people are failing, because I look at a place like where we're at right here, for instance, and I don't know if we're going to go up or go down, but I know that the going down is probably a higher percentage, right? And I make it that higher percentage based on the fact that I have an overall bearish view of this, and that bearish view has not changed, and that view is developed based on a wide range of fundamental factors that I've put together. And I only trade in the direction of my overall view. I trade with the trend, or the trend that I've just, you know, determined is in place. Sometimes that, you know, that gets a little iffy, and I might back off on the trades or look for places where I think there might be a reversal or a reason for a reversal. Nice volume well, low across multi-year low or something like that. Or and the fundamentals start to change.
So you would not go long on the Bitcoin. That's what you're saying.
I can't see any reason to go long. That doesn't mean that we won't have occasional bumps up, which it has.
But you ignore those?
I ignore them. Yeah, it's to me it's a lesser quality, lower probability trade. So yeah, until something changes, why should I change my fundamental narrative and my bias? You know, there is no reason. A lot of people will tell you, well, because it's just oversold, or it's a multi-year bottom, or it's hit this bottom 3 times. Well, if you can show me from a statistical point of view that has some merit, and that merit overcomes all the negative things that are happening in the industry, then I might start listening to you. Otherwise, it means nothing to me. So I base all my stuff on fundamentals, statistical analysis, and highly statistical or high probability setups. And I believe that volume profile provides one of the strongest tools in kind of identifying how price is going to behave, where those lines of demarcation are, where support and resistance are, where are the best places to take trades, and where are the best places to establish targets. See, I couldn't do this course like in a vacuum though, because I can't. Otherwise, then I'm putting volume profile out there as being like the end all be all of trading. It's not. but I do believe that it is the primary tool for analyzing the structure of the market, not all these oscillators and trend lines and moving averages.
Seems like, I mean, like these like whales pretty much correlate with like support or resistance lines. So is there any benefit of them using volume profile if they pretty much correlate? Well, why not just draw lines at the support and resistance area instead?
Well, essentially, that's what you're doing when you're drawing these lines. You are drawing support and resistance and also targets. That is what you're doing. Now, the whales, they're in a completely different platform here. They're moving it up when they think that they can move it up. Generally, a whale will push price up in a down market when it thinks it can get away with it. And what would that entail? Well, that would primarily entail the spread between shorts and longs that are in the market currently. So if they think that there's an overabundance of shorts in the market that they can pop by pumping price up and forcing people out of shorts, they'll do it. A lot of that depends on the position they're in, the position the price is in, the liquidity of the market, maybe nascent news stories that have come out. They wait for all these things and they wait for that opportune time. And if the conditions are right, they'll pump it because that will be their least expensive option to pumping that market up. They'll be aided by those shorts being squeezed out of the market. And then all the other retailers hopping in, thinking the market's going to come in. Then they get in after the move's already been made and start trying to pump it up even some more. But that's their point where they then dump it and then take all those retailers for a ride. If you examine the every single move, every single up move of 200 points or more in Bitcoin over the past 6 months, except for one instance, just one instance, that's one instance out of probably 100. Every single pump of 200 points or more has come within a period of less than 7 minutes. All right? What does that tell you? Does that tell you that there was like this mass hypnosis or psychosis or epiphany, a mass epiphany of all the retailers? They all decided that at 7:05 in the morning that they're all going to push the buy button? No. It's obvious what's happening. It's whales that are trying to manipulate the market based on conditions. And that's what's happened every single time except for once. And that was something that just happened recently a few weeks ago. But other than that, every single move has been a manipulated move up. And so once I started recognizing that about 5 months ago, I've stated that my position is that every single move over 200 to 300 points is going to be followed up by a short. Also given that the conditions are right based on where the volume profile is and where the appropriate places to put those trades in. And so that's what I followed in. And I've hit every single one of those trades, except for one, where I got outside of myself and overcommitted. And I had to exit that trade. And that was actually on April 12th. The day that I think everybody recognizes was a whale pump. It was the largest pump of by dollar volume ever in Bitcoin in a single day. $8 billion were pumped into that market in the period of 15 minutes on April 12th. And that's actually what started one of the bigger moves up.
Wow.
But I was at the bottom of that thinking that it was still going to go down, and I overcommitted myself, and I was short 20 Bitcoin, and it rode me up about $800, which was a substantial amount of money, about $16,000-$17,000 loss in a very short period of time. But I got out, and then I waited for it that move to continue. and then I started shorting it, continuing on with the policy. So I lost about 4% of my account, but I made it up within the next week and a half. So, anyways,
when you trade futures, how many like contracts do you typically trade at a time?
well, it depends on the situation. Depends on the size of my account. Depends on where I am in the trade. Depends on what I'm trading it against. Sometimes I trade both long and short the cash position along with the futures position because I recognize that there's an arbitrage opportunity, a price mislocation. And I'll trade both at the same time. In those instances, sometimes I have much larger positions, but that's because I'm being hedged by the cash position. On this particular instance, I wasn't hedged. I was just balls to the wall, going for something like an idiot, and I paid for it. Anybody else have any other questions? This is sort of Q&A time now.
We'll be able to review this lesson, the recording of it and the sheets, all the.
Yeah. So,
because I plan on going over everything again,
yeah, so what I'll do, I'm hoping to do it today. I may not do it until tomorrow because I'm going to be packing for the vacation.
Yeah.
And then tomorrow morning we're leaving, and so I probably won't even get settled until tomorrow evening. There's a possibility I might find time to do it tonight, but more likely tomorrow night, where I'll publish the video because it will take some time for it to render, and then upload it to YouTube, and then I'll provide you with a private link to YouTube that you can get at it, and I'll provide an email that I'll send out. I send it out to everybody that has ever taken the course, so everybody can see subsequent stuff. So as I do other courses, you'll be able to see those as well. Can we get this in Braille? No, sorry. Oh, wise guy. All right. That's about it, unless you have more questions. The only thing that I would ask is that if you like this training, and of course it's not really over. I mean, you still have the coaching session that you're going to schedule with me in the future. If you like this course, if you could please go to the website, the Trader of Futures website, and provide a review, I would really appreciate that. So I'm going to stop the recording here.